Everyone wants to have their money at their most with as little deductions as possible. Unfortunately, there's a myriad of fees and taxes that's involved in every transaction that you make, and those can all add up to eat away at your money. That said, we'd like to at least help mitigate some of the fees and taxes involved so that you can enjoy your well-earned money and have the freedom to use it for things that matter to you. This is Intelligentsia, real-life advice for practical and financial goals. Today, we'd like to talk about tax torpedoes, what it means to your social security money, and how you can mitigate them. So let's get to it. A tax torpedo is a term used in the United States when talking about retirement fees and taxes. In simple terms, tax torpedoes are essentially hidden traps that essentially eat away at a chunk of your money during retirement. It's basically a situation where the tax rate effectively increases when a person or a couple's income reaches a certain threshold, and as a result, they end up paying more. At these thresholds, a large portion of your Social Security benefits become subject to taxation, with overall tax liability significantly increasing. This also includes other sources of income such as pensions, withdrawals from retirement accounts, and part-time job earnings. This essentially torpedoes people's income and can negatively impact retirement income and savings. As a result, it becomes important for people to understand and mitigate how these torpedoes get to you and how you can enjoy your retirement money as much as you can. Think about it like this. These torpedoes essentially reduce the amount of money you can use during your retirement years. So instead of relaxing and just focusing on yourself with money you prepared for decades, you instead have to tighten your belt and make sure that the money that's left can be used for your everyday expenses. When you're hit with a tax torpedo, you won't have enough money for the things that can bring joy for you or for your loved ones. With higher taxes causing higher amounts of financial stress, you may end up dipping into your savings sooner rather than later. And because of that, you may not be able to enjoy your retirement as much as you'd like. In essence, these matters become hurdles towards your goals in the future, and rather than having a stress-free retirement, you'll find it somewhat challenging trying to balance what you can spend because you may be getting taxed more than you'd expect. There are some strategies that you can employ in order to deal with these matters. Some of these include 1. Tax-efficient withdrawals. If you manage your withdrawals from your retirement accounts, you can minimize the impact on combined income and Social Security benefits. Here are some considerations that you need to understand in order to do this strategy properly. You need to understand the tax rules. It's important to have a good understanding of how your retirement accounts are taxed. These include several retirement accounts such as your 401k, Roth IRAs, HSAs, brokerage accounts, and other investment accounts that you may be using. There may be some similarities in how some accounts are taxed, but there are differences that you need to consider when you decide to withdraw. Consider the withdrawal order. After figuring out the rules in which you're taxed, understanding the order of how you withdraw your money is also important. A common guideline that can help you prioritize things in the following order. A. Taxable accounts. These generally include brokerage accounts and savings accounts. Since capital gains taxes are usually lower than ordinary income tax rates, you can enjoy your capital gains and dividends at a much lower rate of taxation. B. Tax-deferred accounts. These include accounts like traditional IRAs and 401k accounts. Since you don't pay taxes up front, you instead pay them upon withdrawal. And C. Tax-free accounts. These are usually Roth IRA accounts. If you consider tapping into these last, you can maximize tax-free income. When you need money, think about where you should get it from. Sometimes it's better to take money from an account that won't be taxed as much. If you have retirement accounts like IRAs and 401ks, plan how you'll take money out. Taking out too much at once can make your taxes go up, so try to take just what you need. Manage your tax brackets. You need to be aware of your tax bracket. If you're going up a bracket, deferring your income helps you avoid a higher tax rate. Timing of Social Security benefits. When you'll be receiving your Social Security benefits also plays a part in the taxation of those benefits. Understand that if you can manage your tax bracket, you can potentially time when you get paid, thus effectively managing your tax bracket as well as managing when you'll get your benefits. You can choose when to start getting your Social Security payments. If you delay it, you may pay less in taxes on those payments. It can be a good idea to wait until you're a bit older to start getting Social Security if you can afford to. This helps out a lot in the early years of retirement by reducing your taxable income. This effectively mitigates the effect of the tax torpedo. Implementing a systemic withdrawal plan. If you follow a system where you take regular and consistent amounts at regular intervals, be it monthly or yearly, you can effectively budget and manage your taxes better. Consider tax loss harvesting. In your taxable accounts, you can offset capital gains with losses in order to reduce your tax liability. This is a technique called tax loss harvesting. You do this by selling investments that have lost value in order to offset gains in other parts of your portfolio. There are many other tax-efficient withdrawal strategies to employ that can help you out. For the best possible options available to you, we'd recommend seeking professional advice so that you can find out what works best with your financial situation. If it all seems confusing, don't worry. Financial advisors or tax professionals can help you figure out the best way to manage your taxes in retirement. There have been many instances where tax professionals have helped out individuals in managing their accounts and have helped numerous people in saving up a lot on their taxes. Understand that while thinking of all this can be daunting, professional help can really make a difference when it comes to saving up money that you would otherwise have spent on something else. Tax-efficient withdrawals can make a significant difference in preserving your retirement savings and minimizing the impact of the tax torpedo. By carefully managing your income sources and tax liabilities, you can enhance your financial security in retirement. That said, there are other ways to go about reducing the effects of tax torpedoes. Some of these include 1. Roth conversions. If you convert traditional IRAs into Roth IRAs, you're not subject to a required minimum distribution. That said, it can also be withdrawn tax-free since, usually, Roth IRAs are taxed upon contribution. Roth IRAs and Roth 401ks are accounts where you've already paid taxes on the money. When you take money out of these accounts in retirement, you usually don't have to pay taxes again, so consider utilizing these accounts wisely. 2. Diversifying income sources. If you use a strategy of combining taxable, tax-deferred, and tax-free income sources, you can effectively create a tax-efficient retirement income strategy. This can come in the form of having your Social Security benefits while still having an investment portfolio that you still manage. This can also apply to your retirement accounts. Learn how different types of income like money from your job, retirement accounts, and investments are taxed. In retirement, some of this income might be taxed more heavily. From there, you can try to balance where your money comes from. Don't rely solely on one source of income like Social Security or a retirement account. Having income from different places can help you control your taxes better. The main idea is to be smart about where you get your money from in retirement. By spreading out your income sources, making thoughtful choices about Social Security, and using the right accounts, you can reduce the impact of the tax torpedo and keep more of your money for your retirement needs. Now, there may be other strategies to be employed, but for the most part, those are the basic ones that we can cover for today. Taxation is certainly a complex subject, and it's understandable that navigating it and finding the appropriate strategies to mitigate losses is key to enjoying a healthy and happy retirement. If you enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.